And we will get started shortly. We're going to let a few more people come in. And while our friends are joining us, I am going to open up the chat for everyone. Hello, if you can comment in the chat, let's make sure this is working, where you're located, and if you are a current PadSplit host, and if so, where, and if you are not a current host, where you would like to begin hosting. So great, the chat is working. Awesome, welcome, welcome everyone. Okay. There we go. We'll give it a couple more moments, about 2 more minutes for our colleagues to join us. Hey, we got people from Atlanta, Miami, Tampa, San Diego, Illinois, San Antonio. Tampa, Los Angeles, Baltimore. To all my friends in the Baltimore area, we will be having a really cool series of events coming up in Baltimore. We have a mix and mingle. So save the date for the mix and mingle next week in Baltimore. All right. Can you guys hear me? All right, Tracy, we look forward to seeing you. All right, so we will go ahead and get started. I want to introduce our special guest today who is here. His name is Trevor, and he will be sharing with us about his product. So I am going to, there we go. All right. Hey, Trevor, how's it going?
It's going great. How are you?
I'm doing good. I'm doing good. Well, I just wanted to just really introduce Trevor Higgins. He is a lender and he has some amazing products he's going to share about PadSplit. So I'm going to let him get started sharing these really cool products because that's what we're here for. We will also be going, if we have time, going over some PadSplit stuff so I can share some insights with you guys about PadSplit. But I really want to give Trevor the floor so you guys can hear about his products and ask any questions. So Trevor, go ahead and get started.
Awesome. Well, thank you so much, Dominique. Excited to be here and share some updates, especially for all those hosts, right? Active hosts. I'm sure all of you have run into lending challenges. It's something that's new, right? And anytime in the lending world, anything is new, it usually takes a little while for lending guidelines to catch up, right? So we've been lending in the co-living space for about 2 years now, and have really kind of figured out a system to make it work. So excited to share that with you guys. But kind of some high level overview, right? You have a lot of different lending options. Obviously, there's conventional or traditional financing. You have bank statement lending, or 1099 loans, alternative income loans. And then, probably the most used in this world, which is a DSCR loan or debt service coverage ratio, which is going to utilize that cash flow, right? So all of those loans, any type of lending product, the one big thing that I like to tell all co-living investors is one of the notes you obviously we want you guys to maximize your income and your cash flow, but I know Dominique and I have talked about this a few times, and I know she shares this with her hosts. Probably the biggest caveat to all of this is being careful on your room count, right? One of the biggest issues in co-living as a whole is you've got to maintain the integrity of a single family home, right? At the end of the day, that's what it is. And so, I want to kind of dive into that. I'm not going to say there's necessarily a limit because that can vary by market, that can vary by the size of the house. But you definitely don't want to compromise all the common space. And what I mean by that is, when a lender, any lender, whether it's a commercial loan, whether it's a DSCR loan, a conventional loan, it doesn't matter the type of loan. When a lender looks at a property, one of the first things they're going to look at is, hey, if this loan goes into default and we have to foreclose on this property, can we sell it to a family? And so that is what I wanted to start with, that because I want, anytime you're planning, you're going through and running numbers on a potential project, I want you to start there and look at whether it's a blueprint or a sketch of what your plans are. And would a family be able to utilize that house, right? Does it have a common area like a living room? Doesn't mean it can't have a living room and a family room, right? Or so there's caveats to that, but does it have a kitchen? Does it have a dining area? That could be a breakfast nook. It doesn't necessarily have to be a formal dining room, but you want to keep some of those common areas alive. Because again, if any lender looks at that property and they say, hey, there's no way we can turn around and sell this to a family, then they're likely not going to lend on it. Now, again, there's exceptions for everything. So note that, right? Especially in the DSCR world, right? It's portfolio lending. So there's exceptions for everything. But in general, I wanted to start with sharing, keep that lens, right? Would a lender, if a lender were to take over that property, would they have to knock down walls in order to sell that to a family? Now, if you're going to convert the garage or add an ADU, all of those things are fine. All of those things are acceptable. But I wanted to start with that lens because that's an overall picture for any type of loan, right? Um, Now, that being said, DSCR loans, one of the most commonly used loans out there in terms of whether it's acquisition or refinance. So, one thing that we've done, we are predominantly lending our own money. There are times where, special scenarios or products where we have to broker it out. And I'm sure a lot of you are familiar with that process. But the majority of things, about 95% of loans, we're doing in-house. It's my underwriting team, it's my processing team. And what that allows is, A, you avoid the broker fees, right? That 1.5%, 2.5% sometimes in broker compensation. You avoid that. So you don't have to have that. So it's a great savings right off the rip. But we have the ability now to utilize a DSCR loan to be able to refinance, right, a property that is rented out by the room, whether that's on a PadSplit lease or another management company, whatever that might look like. And we can utilize that room rental income with at least a 3-month history. So that's the big kicker. You need a 3-month history of that income to be able to utilize that cash flow. So that's opened up a ton of opportunities for our clients, being able to avoid the broker fees and being able to refinance that. Now, I know there's a ton of scenarios as far as tapping into equity and refinancing. With when you do renovations, utilizing the ARV. So there's a lot of specific scenarios around that. And that is purely going to be dependent on the exact product that we're using. But there are ways to also take advantage of the market value when you've owned a property for less than 6 months. Just keep in mind that with any DSCR loan, on the acquisition, there is no way to utilize PadSplit income without that history, right? And so, because if you think back, right, short-term rentals, most of you know what AirDNA is, right? We in the lending world, we utilize that to substantiate short-term rental income. Well, in this current market, there is no accepted AirDNA tool for co-living income. So until that tool comes out and then gets accepted by underwriting and by lenders, there's no way to substantiate what that income would look like on the acquisition. So your acquisition on a DSCR loan is always going to utilize either long-term market rent, if that works for the cash flow, or AirDNA for the short-term market rent, depending on what route we want to take, what market it is, and what makes the most sense. On the refinance side, you're able to tap into the cash flow of the co-living property. And I think that's the biggest win on the lending landscape that we've seen, because there's a lot of places you can go and get a DSCR loan. But in this complex world, most lenders don't know what they're doing when it comes to co-living. And I say that because, we've even seen, I think it's 3 or 4 DSCR investors actually add in, no room rentals or no pad split into their guidelines. And so having a loan officer that's familiar with what you're doing, how it operates, and how it works is extremely pivotal in your success. And so, yeah, I wanted to obviously share that with you, but there are ways to do what you're looking to do. And usually what I tell clients to do is every scenario is unique, right? How long have you owned the property? How much history of income do you have? Is the lease set up through PadSplit? Is the lease set up through your own management company or another management company? All of those questions can determine what type of product is going to be used. And ironically, on the benefit of not just because we're on a call with PadSplit, but PadSplit leases are actually becoming more accepted slowly in the underwriting world, because it's a large platform, right? The largest platform in terms of management. So working with PadSplit is actually going to benefit and make that refinance process easier for you, especially if you're utilizing a short-term bridge or hard money loan to complete your renovations and then refinancing that into long-term financing. So wanted to get that out there and share that with you. Again, I'm sure we'll have a lot of questions. I can already see a bunch of questions popping up in the chat, and we'll get to those. But yeah, I did see a couple of notes on here. Just a reminder. So on substantiating the co-living income, it's not necessarily that there aren't tools out there. It's just that none of them are accepted from an underwriting perspective. Just for some perspective, AirDNA was out for almost 3 years before lending guidelines caught up and said, hey, we like this product. We are able to utilize this product, in terms of underwriting guidelines. So there are tools out there, but until lenders, investors, Wall Street, which is really making these decisions on lending money, until they become more comfortable with it, understand it, and are willing to accept that risk, we won't be able to use any tools to be able to substantiate the co-living rents on the acquisition side. Outside of that, again, there are plenty of other products available that we've looked at, in terms of there's DSCR home equity loans. There's, just standard traditional home equity loans, bank statement home equity loans. So there's a lot of products out there that a lot of people don't realize they exist, and it allows you to be able to best capitalize on your investment and also scale your investment. One of the biggest things that we look at for our investors, and as a real estate investor myself, is something called your return on equity, right? So when you first buy that property, you get it leased up and it's starting to produce some cash flow. That return on equity, it might be 15%, it might be 20%, depending on the numbers in the market. But as that equity position grows, that's shrinking, right? Now you have a bigger chunk of equity and your cash flow is not increasing as fast as your equity position in most cases. And so I mentioned that because it's also a good metric to monitor. And why we monitor that is determining when to either A, pull out equity if you're trying to scale and grow, right? Maybe we need to tap into some of that equity and go take on a new property or another project. Or B, Maybe it's time to, you have a significant amount of equity, and maybe it's time to 1031 that equity into two properties, right? And so taking a look at those metrics are also something that I find extremely important in the investing world, just because it's not a common metric that's looked at. Um, Outside of that, let's see if, let me get some of these questions up here. Yeah, I see, Mo, your comment about temporary walls that can be removed to close in living rooms and family rooms. No, that's a perfect idea. In fact, I've had phases of renovations with a lot of clients. So what I mean by that is they do phase one in renovations to put in a couple of bedrooms, but nothing crazy. They keep that common space. We do the refinance to get them in that long-term financing, and then they go back and do the rest of the renovations to maximize that cash flow. Absolutely a great idea to kind of work through that process. Um, as far as the layout on DSCR loans, the layout is not necessarily as important, as it really comes down to the appraiser's comments about marketability and saleability as a single family home. Good question, Tracy. So the layout itself doesn't necessarily matter, but again, having that lens around, can you turn around and sell this house to a family without knocking down walls? That's the easiest way to answer that question. The layout, again, we've had people add bedrooms by converting a garage into a couple of bedrooms, or adding an ADU, finishing an apartment above the garage, something like that. Those are all fine. The layout itself is not necessarily the problem. It's just maintaining that integrity of a single family home. So a family isn't going to live in a 2,200 square foot house with 12 bedrooms, right? And no common space. You want to maintain some of that common space in the property. Be already fixed with walls. Yeah, Hugo, I saw your question about fixed with walls before the DSCR loan. Again, same kind of answer to that. Renovations absolutely can be completed prior to any refinancing. It's just making sure that that common space, a family can buy that property. Um, And then I see, Tracy, your question on income. Yeah, so for DSCR loans, that's going to be a 3-month history, 3-month history on that. As far as conventional loans, that's going to go by either the tax returns, what you report on the tax returns. If it's a property that has been put into service, let's say you bought it this year, it's now in service and it's generating income. It's going to be based off 75% of the lease income on a conventional loan. Typically, in most cases, on a bank statement or 1099 loan, or any type of alternative income loan, they're going to do something similar as far as utilizing 75% of the lease income. Um, let's see what else we got. HELOC DSCR loan. Yeah, so on the second mortgage, or a HELOC, that is going to utilize the cash flow ratio. So again, it just depends on the history of the property. How long has it been in service? How long have you had it? For any type of second mortgage product, you need to have a minimum of 6 months history, or I mean ownership. There, you can't get a HELOC prior to that 6 month of ownership. After 6 months of ownership, it's just going to be based on when the lease was put in place and the rents received. But it's just going off the complete DSCR ratio, and that DSCR ratio is going to be comprised of the first mortgage payment plus a fully amortized second mortgage payment based on the balance. Those are going to be limited to 75% loan to value maximum. So if you take that current market value, take 75% of that, subtract your first mortgage, you would get the HELOC, the maximum HELOC amount that you would be able to take out on that property. Refinancing portfolio loans. Yeah, yeah. I mean, any acquisitions, whether you have seller finance note on there, whether you have a private money note on there, whether it's a portfolio loan, they're all going to be treated the same. We treat all of those the same. It's just getting a payoff. And then, hey, are we doing cash out above and beyond that payoff plus closing costs? Or are we just doing a rate term refinance and refinancing that balance plus any closing costs that you're rolling into the loan? Um, Yeah, Ike, great question. Commercial world income approach is generally used to determine the valuation. No. So in the DSCR, we're commercial loans. So we do commercial loans. And yes, that's true. The income approach can be used in the commercial loan side of things. But in the residential world, no. So the comps are the comps, right? The comparables to that property, the value of that property is the value of that property. The income approach is not going to be used, whether it's a DSCR loan, conventional loan, alternative income loan. It's all just going to be based on the comps that the market show and that value. The income itself um, does not create additional value like it would in a potential commercial loan. Good question. How long do you have to own a property until you can use a new appraisal? That's another great question and one that we get really commonly. So overall blanket, if you've owned that property for at least 6 months, it's extremely easy to pull to be able to utilize current market value. Anything less than 6 months, it can be done, but in order to be able to do that, significant renovations have to have been done to support a higher value, to be able to use that market value when you've owned a property for less than 6 months. And we've got to document those renovations that were completed. So, and by significant, I don't mean like a paint job and some flooring. I mean significant renovations in terms of updating kitchens, bathrooms, everything. So they want to look at, what have you done to the property to add value to this property to justify us being able to use a higher market value than the purchase price, because pretty standard out less than 6 months, if you haven't done significant renovations, the maximum value that's going to be able to be used is going to be the purchase price plus the price of any renovations. That's going to be your total, cost, and that's what the loan to value would be determined from. Um, Multiple properties in one pool of loans. Yes, great question. So cross collateral loans are absolutely something that we do and that we offer. They are not as fond of the room rental space as of today. Uh, and a lot of lenders have actually they don't like cross collateralization just because if you want to sell a property, one out of a group of, let's say, five, they have to completely redo the loan. In most cases, you have to subtract the value of that property because the loan's based on the value of all five of those properties. If you remove one, then it's lowering that loan to value. But they are available. They're not, but I will say they're not as accepting in the room rental space as of this very moment. Um, Multifamily and get lending. Yeah. So we've done duplexes, triplexes in the co-living space. Anything that goes over 4 units is no longer a residential property. It's technically a commercial property. There are products available for that, but it totally depends on the amount of units in a multifamily property. And also how it's deeded, what market it's in. Um, as far as that goes. 1031 apply to multi-unit property. So let me just start by saying I'm not a tax expert. I'm not an accountant, but a 1031 you can change asset classes, right? So if you're going from commercial and want to go into residential, or you're going from residential and you want to go into commercial, you can do that, right? You can change your asset class utilizing a 1031 exchange. The key is it's a like kind exchange, right? So if you're selling an investment property, it has to be moved into another investment property. It cannot be moved into a primary residence. And so long as that stays true, and you have your qualified intermediary, which you'll want to contact before you even start a 1031 exchange, as required. Um, yeah, you can change asset classes anytime. Is it easier to get a loan for PadSplit? Yes, actually it is. It is. Again, just because a lot of these decisions, so you have different investors, right, that do these DSCR loans. It's them backing the loan. And a lot of those investors, the Wall Street guys really making the decision on what they want to take on and what they want to lend on and what they don't, generally like a company that's bigger, that has a larger footprint, and that also has a longer history. So not to say that you can't do it with a private management company. That's not necessarily the case. But having utilizing the PadSplit platform does absolutely make things easier. Um, John, I saw your question about co-living loans based on the property income or heavily on personal financials. So that's depending on the loan product, your traditional conventional loan or bank statement loan, alternative income loan. Those are gonna bring in personal income into play, whereas a DSCR loan is only looking at that property's cash flow. It's only looking at that property's income versus that PITIA payment. It's just underwritten on that debt service coverage ratio. And generally, we're looking for a 1.0 or better, um, in terms of what we're looking for on that ratio. Granted, I mean, you as an investor are probably going to want your ratio to be a little bit better than that. But that's a good question. Um, Ori, let's see, mean that we can get a higher value based on the co-living income. How does that work with appraised value based on single family home? Yeah, so again, that one, the value of the home has nothing to do with the income, in a standard DSCR traditional sense, right? Any type of residential lending product, is not gonna, the income on the property does not have a bearing on the value. That's only going to be in the commercial space, in the commercial world, in which you're going to have an income-based approach and be able to value a property based on that cap rate is really what they look at. How would you suggest wanting to finance a home that's listed on the MLS as a normal residential, but it has a 4,000 square foot and a separate mother-in-law suite? Yeah, yeah, great question. So typically on any acquisition, right, until these underwriting and guidelines update, on any acquisition, we're going to look at traditional long-term market rent for that DSCR loan ratio calculation, or AirDNA short-term rental calculation, um, until they get more accepted of the tools that are estimating co-living income, and until they start wanting to, be able to utilize those in the underwriting world. It's all going to go off long-term market rent, or it's going to go off of the AirDNA income. Now, when you do have either a multi-unit property, or you have a mother-in-law suite or ADU on a property, income for the DSCR ratio, income for that unit does count towards the DSCR ratio. So keep that in mind. It does make sense. But as far as what loan product to use, that's going to be a just, really based on the individual person. So we have clients that'll utilize, um, traditional full doc conventional loans to purchase a property and move it over to an LLC after closing. And we have clients that just like the DSCR process because it's a lot less documentation and it's easier to navigate. And so they'll use that DSCR loan on the acquisition side as well. DSCR loans, minimum down payment is traditionally 20%, just depending on the DSCR ratio, the market as well. You know, while you're looking at properties, do note that rural areas are also make a complexity from a lending perspective, right? If we're lending based on the cash flow of that property and you're in a very rural market, so we're talking about a population of 20,000 people or less, that's going to have less demand, and so that's going to add typically have a higher down payment or higher interest rates because of the risk involved in a rural property. But most of the time, down payments are typically going to be 20 to 25%. Again, just based on that DSCR ratio and what that looks like. Let's see. I'm interested in DSCR loan. We have not acquired the property yet, so can't show any cash flow. Yeah, so on the DSCR loan, we're going to utilize that long-term market rent initially. So on that appraisal, the appraiser will give us a market rent calculation for long-term market rent, or we'll use AirDNA to calculate the short-term market rent to calculate that DSCR ratio on the front end. Once you're in the refinance phase, then we're going to utilize the existing rent that you're collecting. So just depends on the history and how long you've had that property in service. Property insurance coverage, yes. So that is actually a really, I'm glad you brought that up. That's a really good point. To the best of my knowledge, and I'm not an insurance agent, but to the best of my knowledge, there's not necessarily a insurance company out there right now that's actually insuring co-living properties for co-living itself in the way that it's traditionally done. In fact, a lot of investors, especially if you go through the claims process on a property, like here in North Carolina, we had that hurricane come through here. And so there were some claims made, and a lot of those companies, after that claims made, they're dropping those policies because they're finding out 6, 7, 8, 9 adults that are not related are living in the same property. Now, that's soon to change, updates to come on that. There is a company that's working on a program, a national program, specifically for co-living insurance. But at the very moment, typically, I just recommend most clients to get a standard insurance investment property insurance policy because that's really the only option. Outside of that, there is a secondary market that would insure it for a room rental, but it's a company that there's a couple of companies and their insurance policies that are used for like fraternity houses and sorority houses. So they're usually 3 to 4 times the cost of a traditional investment property policy. From a lending perspective, we don't care what policy you get or who you go with. It's what we look at is we get something called the replacement cost estimator from the insurance agent, and we just want to make sure that they're insuring it for the replacement cost or greater. That's really all we're looking at from a lending perspective. But outside of that, in terms of insurance coverage, there's really no more requirements outside of just meeting replacement costs. Yeah, great question. HELOCs on investment properties owned by an LLC. Even the DSCR HELOC, unfortunately at this time, does not allow it to close in an LLC. We have to quit claim it over to your personal name, close the HELOC, and then quit claim it back to the LLC after closing. There's not a product that I'm aware of on the residential side. There are commercial related products, but they operate a little bit differently in terms of second mortgages, whether that's a home equity loan or a home equity line of credit that allows you to close in an LLC. Now, it doesn't mean there's nothing out there that's available, but there's not any products out there that I'm aware of in the residential space that are doing any type of second mortgages through an LLC. Um, Yeah, I see a bunch of more questions about the insurance side of things. Again, yeah, there's a company that's working on an actual co-living policy that should be probably available, I would say, in the next 2 to 6 weeks. But at this given time, there's not really much out there for a traditional co-living, a co-living property or room rental property that I'm aware of. So that is just working with we send our clients to an independent insurance agent, broker, and oftentimes they're just a normal investment property policy of which you could run into that issue, pulling coverage after closing or pulling coverage after a claim, and then you just have to navigate that process with your insurance agent. Um, Converting garage and ADU be done and rented out before DSCR loan? Yeah, great question. So no, any type of garage conversion or ADU, can be done prior to refinancing. Those things is the big thing that we're looking at is the actual common area of the house, right? Can a family live in there? But in terms of a garage conversion or an ADU being added, those things are absolutely acceptable. The big key on that is make sure you understand your local municipality's regulations. You want to make sure that you're following any regulations that your local municipality may have. So if there's a permit required for that and you go to do a loan, we do an appraisal, and there's an unpermitted garage conversion or an unpermitted ADU added, that is going to create some lending issues on that side of things. So just be aware of that. Make sure you're following the rules and regulations of whatever municipality or market that you're working in, because those things can cause lending issues. Um, Especially on a DSCR loan where we want to be able to utilize the cash flow from those additional rooms and spaces. If they're not permitted and you're not supposed to have them, then that's going to be really hard to be able to utilize that income. Yeah, Ori, great question. If the comps are the comps, where does the high income from PadSplit help us in the refinance process? Well, if you have gone through a DSCR process, in most markets, there are still some markets out there that are cash flow positive, utilizing long-term market rent. But if you're utilize long-term market rent, especially at an 80% loan to value or a DSCR loan with 20% down, is not going to cash flow a 1-to-1 ratio. So the benefit of being able to use the higher income from PadSplit allows that ratio to improve, right? That cash flow ratio, utilizing that income allows you to go up to higher loan to values, and typically is going to give you access to better interest rates because the loan to value and the interest rate is going to be based off what that debt service coverage ratio actually looks like. Multifamily and what is the max number of units? Yeah, so multifamily, absolutely. There is no max. It just depends on the market. Generally, most DSCR loan products are going to be able to handle 8 to 10 units in the multifamily space. Anything over that is going to go into a full-blown commercial product. And so there's a little bit different requirements as commercial loans are going to do a little bit, they still underwrite a DSCR ratio, but they're going to look at a lot more expenses when it comes to the commercial process. They're just not going to look at the mortgage payment, the taxes, and the insurance. They're going to look at more expenses and a total cash flow ratio in the commercial space. Um, how much skin in the game down payment is required by your lenders in a fix and refinance loans on DSCR loans? Yeah. So in a fix and flip or bridge loan, short-term loan product that you're using, kind of like a hard money loan, whatever you want to call it, where you're utilizing it to cover renovations and the acquisition of a property. The max, at least that the best that I'm aware of that you can do is going to be 90% of the loan to cost. Your loan to cost is going to be the acquisition price plus your renovations. So 90% of that, but it has to equal at least 75% of the after renovation value. So how they look at it, there's two separate calculations. You have loan to cost and your loan to value, and that's based on the ARV or after renovation value. The maximum that they will lend you is going to be 90% of the loan to cost or 75% of the after renovation value, whichever one's the lowest. So keep that in mind when you're looking at hard money options out there. Are you a lender or loan officer or both? I'm a lender, loan officer. I mean, it depends on what you mean by that. I'm not 100% sure, but more about Fairway. So Fairway is the second largest retail lender in the nation. We lend in all 50 states. We've been around for 28 years. And I'm based out of Charlotte, North Carolina. But we do lend in all 50 states. I personally don't hold all 50 state licenses. That would be a lot of continuing education. So I don't want to go through that. But our team does handle all 50 states in terms of lending and loan products. Credit score needed to qualify for a DSCR loan. Yeah, so most places are going to require at least a 660. There are options for down to a 620, but your loan to value is going to be limited to much lower when you have a lower credit score. So the big things that are going to limit that loan to value ratio are the DSCR ratio or that cash flow ratio and your credit score. Those, because we're not underwriting personal income, we're not looking at personal debts. And in fact, on DSCR loans, we do pull a credit report, but we delete everything outside of the mortgage that we're focusing on. We don't look at credit card payments, we don't look at car payments. It's just based on the cash flow ratio of that subject property. And again, the benefit of DSCR, there's no debt ratio. There's no debt ratio. It's just based on the cash flow of the property. 20%. Yeah, 20% down is pretty standard for a DSCR loan. Do you take into account the operational expenses or just rental income for a DSCR loan? So in a traditional DSCR loan on a residential property, they're not going to look at any rental expenses outside of your principal, interest, taxes, and insurance, plus association HOA dues if there is an HOA. That's all they're going to look at. They're not going to look at any type of management fees, landscaping, cleaning. We're not looking at any of that as expenses. On the commercial lending side, we are looking at a lot more of the total expenses. So just depends on which lending product you're going with. But typically in most DSCR loans, we're just looking at the ratio of the rent versus the mortgage payment with any applicable HOA dues. That being said, a big note, if you are looking at a property in an HOA, make sure you do your due diligence. Make sure that there are no rental restrictions. I've seen a few cases where clients have gotten themselves in a rough situation with hefty fines adding up because of not doing that due diligence on an HOA. I highly don't recommend buying co-living or room rentals in an HOA community, but it sometimes can make sense based on those restrictions and covenants of the association. Can you get a commercial loan on a pad split house? Yes. Yeah, you can get a commercial loan on any residential property. The biggest thing that, again, the commercial loans are different, right? So typically, most traditional commercial loans are going to be amortized over 20 years, and they're going to be a 5-year maturity, which means in 5 years, that loan's either going to have to be refinanced, the rate's going to adjust. So there are different things that you have to look at. They operate a little bit differently, but you can do a commercial loan on a single family home when it's an investment property. Let's see. So somebody thought you said that earlier on the call, the income generated on the property would impact the valuation in the DSCR refinance. So the income generated affects the DSCR ratio, which is going to impact the interest rate, is going to impact the ability to do the loan. But the valuation of the property is going to be based on just the actual market value of that property. The income itself in a standard traditional DSCR loan, the valuation is not going to be affected by the amount of income that that property is bringing in. Please explain AirDNA. AirDNA is just a tool that will give you data on a short-term rental. So it'll give you an average, right? An estimated occupancy rate, estimated gross income amount. It gives you a lot of data in terms of the short-term rental or Airbnb and VRBO market. Joey, what's the highest LTV and lowest points you can do? So with all of our options, typically we have no point options. Anything that's done in-house, we don't charge points on. We have one flat origination fee. It's $1,295. That's it. There are no points involved. As far as highest loan to value, in most cases, as far as a DSCR loan, that's going to be 80%. So that's going to require a 20% down payment. We do, conventional loans will go as little as 15% down. We also have some specialty investment products that allow as 15% down as well. But in the traditional sense, 20% down is the most common in terms of the loan to value. Now, that could change. This is a good segue into the DSCR ratio. So on the acquisition, one thing that a lot of loan officers, if you're talking to different loan officers or brokers out there that maybe aren't familiar with DSCR lending, they know they offer it, but they don't know a ton about it. They might tell you that you can do 20% down. However, because on the acquisition, we're utilizing long-term market rent or AirDNA income. If that DSCR ratio falls under 1.0, it's going to require 25% down. That is going to be the minimum. So just keep that in mind. That's why a lot of times when we have clients that are looking to write an offer on a property, we're going to take a look at those numbers on the front end. What does our market rent on the long-term side look like? What does AirDNA look like? Can we get these numbers to work, assuming that that's where those figures come in? And so there are ways to do 20% down. But if you're in a market, for example, Houston is a great market. Insurance is extremely expensive. When you have an investment property, taxes are expensive. And so when you're looking at long-term market rent at 20% down, chances are that DSCR ratio is not going to hit a 1.0. Anytime if it falls below that 1.0, it's not that we can't do the loan. We could still do the loan. It's just going to require 25% down. Please clarify, use the income of the last 3 months. Yeah, great question. So on the purchase, any purchase, there is no history of co-living rent quite yet. So we're going to look at that long-term market rent, or we're going to look at that AirDNA. Once you're into a refinance, that's where we're going to do that 3-month rental history, and we're going to use that for the DSCR calculation. As far as reaching out, I will make sure to drop. We'll send out an email after this to everybody that attended with the contact information, so we can get in touch if you have any questions or want to go through specific scenarios. Loan products recommended for properties in need of repairs? Great question. So we do have conventional, so traditional full doc, full income qualifying as far as personal income versus personal debts, renovation products for investment properties. That is one option. The other option is looking at what we call bridge loans or hard money type products that are going to allow you to roll in the cost of those repairs. And then we refinance that into long-term financing because most of the time those are going to be short-term loans, right? 12 to 18 months is the most common. And so we're refinancing that once the renovations are completed into a long-term product. Yeah, as far as is it one DSCR loan in two phases for the acquisition and the refinance or two loans? Yeah, great question. So it just depends, right? You may not be in a situation to where you need to refinance. It just depends on what your objectives are, right? A lot of times we're looking at refinance options to if you've added significant renovations and you want to tap into that after renovation value, maybe pull some of the cash that you've injected into the project. Maybe you want to try to recoup some of that capital. We'll look at a cash out refinance. And so in those cases, or let's say you acquired that DSCR or you used the DSCR loan to acquire a property and the rate was significantly higher than what it would be with the new DSCR ratio utilizing co-living rents, then you may want to refinance. But it just depends on the scenario, right? You don't want to do a refinance that for no reason. There's got to be a reason. So it's just going through that scenario to figure out what that looks like. Minimum DSCR ratio. So we have several no ratio products. Those are going to require at least 25% down. In terms of if you're looking for a 20% down or 80% loan to value, that DSCR ratio is going to be 1.0 minimum required. If it's a short-term rental and we're utilizing Air DNA at 20% down, it's 1.5. DSCR ratio that's going to be required. So it just depends on, what type of rent we're utilizing on the acquisition. Floyd, great question. Is there an absolute 3-month payment history to refinance a co-living house? Great question. Not necessarily, right? That is just specific for our in-house product. We do have broker products that we're able to tap into that will just utilize the lease with 1 month's rent received, or at least a security deposit that equals 1 month's rent. Then you can utilize that co-living rent. But in most cases, that 3-month history is usually going to be a little bit better because anytime you're brokering, there's going to be additional fees for that. Heather, I'll answer that one again, just in case anybody missed it as well. No problem there. You can absolutely add rooms before you refinance. The big key to that is making sure that you're leaving common space, right? If a family, if you can turn around and sell that home to a family and they can use it the way that it is today, then you're fine. You're fine. The biggest thing you don't want to do in terms of if you're planning to refinance is compromise all the common space, right? You're turning the dining room into bedrooms, you're turning the living room into bedrooms, you're turning the garage into, you're taking up all the common space and turning that to bedrooms to maximize your profits. That's what you don't want to do before you refinance. It's very, very difficult to get lending on a property like that because just to explain that again for anybody that missed it, a lender's looking at this as, hey, if we're going to lend you this money and you default on the loan and we have to take this house back, we have to foreclose on this house, can we turn around and sell it on the open market the way that it is, or are we going to have to take down walls? That's exactly how they're going to approach that scenario. Denver is a new pad split market. Are lenders hesitant to lend in new markets? No, no, I don't think there's any hesitancy there. On the acquisition, it's still going to utilize long-term market rent or the AirDNA. On the refinance side, it's going to utilize the history that you have. So the market itself, if it's a new market to pad split, doesn't necessarily affect the loan in any way. However, rural markets do, right? From a lending perspective, if we're lending money based on a cash flow of a property and it's a very rural market with a small population, that means there's going to be less demand. That means there's going to be higher vacancies, right? And so we're looking at those things and we're taking those things into consideration when we're looking at markets. It's not to say that there aren't options available for rural properties. They're just either going to come with either higher down payment requirements or they're going to come with higher interest rates based on how rural the market is. The other side of that is there are some rural, quote unquote, markets, but they're close to things. Like one of the biggest examples that I use, because we've done a few here, is Kentucky, right? You've got the Bourbon Trail. There's all these bourbon distilleries. Well, there's not most of those towns around the distilleries on the Bourbon Trail are rural. A lot of them, their population is between 8 to 15,000 people. That's a rural market. And so that when that happens, because there's an attraction around it that draws traffic and draws people, typically there's an exception available for that. So, all of this to say, guidelines in the lending world, they're not necessarily just check the box, check the box, check the box. There's always going to be outliers. It's all just about risk mitigation, right? So whether that's risk mitigation from you as a borrower, you have really strong credit, you have a lot of reserves, in the bank, you have good compensating factors for taking on more risk, or whether that's based on the property itself. There's exceptions available on anything. It's just really based on the scenario. Current rates like with the 20% down payment. DSCR rates, depending on the scenario, the DSCR ratio and credit score, if you have a prepayment penalty or if you don't, they're going to range from the high sixes to mid sevens in general. Let's see. I built 4 townhomes, 4 bedrooms each last year, closed in February, loan appraised $290 each, current loan $222. Averaging. All right, Gary, I saw your townhome question. Yeah, so that's just based on the history, right? We can tap into that pad split income of $3,750 as long as you have 3 months history of receiving that rent in your bank account. We can utilize that $3,750 for the DSCR loan calculation. Stay away from an HOA. Lord have mercy, nightmare. Yes, I 100% agree with you, Felicia. That is very true. Bum, bum, bum.
So for the sake of time, Trevor, thank you so much for your time.
Yeah.
You have a hard stop at 2 p.m. because there's another
Yes.
of it going on shortly. But thank you so much for your time. How can people get in contact with you?
Yeah, I'll drop my contact information in the chat. We'll also send out an email afterwards to everybody. If we didn't get to your question, be happy to answer it. So feel free to reach out. There's my email address and my cell phone number. Feel free to reach out anytime and we can talk through any scenarios or situations that you might have. Thank you guys so much. Glad I could hopefully share some insights on the wonderful world of PadSplit.
Awesome. Thank you guys so much. And we'll send out the replay as well as our contact information for any other questions you may have. All right. Have a good day. Thank you again,
Awesome.
Trevor.
Thank you, Dominique.
Okay.
Have a good one, everyone.